In 1870, Britain was the wealthiest nation on earth. By 1900, Britain's GDP per capita exceeded all nations except Australia and the United States. The British Empire controlled 23% of the world's population. Sterling was the global reserve currency. London was the undisputed financial capital of the world. And then, through a series of catastrophic financial decisions spanning 7 decades, Britain transformed from global superpower to a middling European economy desperate for IMF bailouts. This isn't a story about military defeat or natural disaster. This is a story about how financial mismanagement destroyed an empire. Let's begin. The first crack in the British financial system appeared in 1914. When World War I began, Britain's national debt stood at just 25% of GDP, the lowest level in 200 years. The empire was financially sound, militarily dominant, and economically unmatched. But by 1919, just 5 years later, the national debt had exploded from £650 million to £7.7 billion. Debt to GDP ratio reached 135%. More importantly, Britain had fundamentally altered its relationship with the United States. Britain borrowed heavily from America during the war, and by 1919, though Britain was technically a net creditor, the power dynamic had shifted permanently. Here's what made this different from previous British wars. After the Napoleonic Wars in 1815, Britain's debt exceeded 200% of GDP, but Britain was the creditor. British capital financed global development throughout the 19th century. After World War I, Britain owed massive debts to America, while Britain's own debtors, France and Russia, either couldn't or wouldn't pay. By the mid-1920s, interest on government debt was absorbing 44% of all government expenditure, comfortably exceeding spending on defence until 1937. Think about that. Nearly half of every tax pound collected went to servicing debt, not building infrastructure, not funding education, not maintaining industrial competitiveness. And this is where the decisions became catastrophic. In April 1925, Winston Churchill, serving as Chancellor of the Exchequer, made what he later called the biggest blunder of his life. He returned Britain to the gold standard at the pre-war parity of $4.86 per pound. The problem? Sterling was overvalued by approximately 10%. At the market rate the previous year, the pound had traded at around $4.40. Churchill, advised by the Bank of England and Treasury officials, chose national prestige over economic reality. He wanted to restore Britain's pre-war status. He wanted sterling to symbolise strength and stability. The economist John Maynard Keynes warned Churchill explicitly that this decision would lead to unemployment, downward pressure on wages, and prolonged strikes in heavy industries. Churchill ignored him. The consequences were immediate and devastating. When you raise the value of sterling by 10% overnight, British exports become 10% more expensive to foreign buyers. For a nation that operated as a factory, importing raw materials and exporting finished goods, this was economic suicide. British coal, textiles, and manufactured goods could no longer compete in international markets. Export industries collapsed, unemployment soared. But the damage went deeper than unemployment statistics. By overvaluing sterling, Churchill transferred approximately £1 billion into the pockets of bondholders, the rentier class, out of the pockets of workers and manufacturers. The real burden of the national debt increased by roughly £750 million, completely wiping out all contributions to the sinking fund since the war. British industry suffered, British workers suffered, but British creditors prospered. Between 1979 and 1989, Britain shed 2.5 million manufacturing jobs, a decline of 1/3. France and Germany during the same period lost only 10 to 13%. The return to gold at the wrong rate didn't just damage British exports. It forced America's Federal Reserve to intervene. To prevent Britain from losing gold reserves to the United States, the Fed deliberately depressed interest rates at home and weakened the dollar. In other words, to help Britain maintain the fiction that sterling was stronger than it actually was, America's central bank made the dollar artificially weaker. The result? Currency and credit expansion in the United States, artificially cheap interest rates, and the roaring 20s boom that set up the conditions for the Great Depression. Churchill's blunder didn't just damage Britain, it contributed to a global economic catastrophe. British industry never recovered from this self-inflicted wound. While the 19th century had seen Britain achieve sustained economic growth of around 2.07% annually and pay down the Napoleonic War debt, the interwar period saw stagnation and decline. Industries that had been globally dominant, coal, steel, shipbuilding, textiles, began a long, slow collapse. The The proper policy would have been to recognise sterling's real market value and stabilise at that rate. But prestige mattered more than prosperity. Symbolism mattered more than competitiveness. And the British working class paid the price while bondholders collected their interest. And then came World War II. Britain entered the war in 1939 with national debt already at 135% of GDP, still struggling with the legacy of World War I debt. By 1945, the debt stood at £21 billion. Debt to GDP peaked at approximately 270%, higher than after the Napoleonic Wars, higher than after World War I, the highest debt burden in British history. The war had cost Britain an estimated 84% of GDP. Britain had sold off massive overseas investments that previously generated income. The nation had borrowed extensively through the Lend-Lease program from America. When Lend-Lease ended abruptly in August 1945, Britain faced an immediate economic crisis. Industrial production had been geared toward wartime needs. 55% of GDP in 1944 had been war production. Export industries had been neglected for years. Britain desperately needed to import food and essential consumer goods, but lacked the export income to pay for them. John Maynard Keynes, already in poor health, was sent to America to negotiate emergency financing. The result was the Anglo-American Loan of 1946. $3.75 billion from the United States, another $1.19 billion from Canada, at 2% interest over 50 years. The loan came with devastating conditions. The most damaging was mandatory convertibility of sterling. 1 year after the loan was ratified, on July 15, 1947, nations holding sterling balances became able to convert pounds to dollars. Within 1 month, nations with sterling balances had drawn almost $1 billion from British reserves. The government was forced to suspend convertibility immediately and begin drastic cuts in domestic and overseas expenditure. The weakness of sterling was exposed. In 1949, sterling was devalued from $4.02 to $2.80. The fiction of British financial strength was over. Now here's the pattern that's critical to understand. After the Napoleonic Wars, Britain spent the entire 19th century paying down debt through economic growth. Not austerity, not tax increases, but through decades of industrial expansion and trade dominance. Between 1815 and 1914, the debt-to-GDP ratio fell from over 200% to 25%. But after World War II, Britain no longer had that option. The industrial base was weakened. Export markets had been captured by competitors during the war. Sterling was no longer trusted as a reserve currency. The empire was economically unsustainable. Britain still owed roughly £14 billion to Commonwealth members for wartime assistance. These sterling balances, particularly held by Egypt and India, represented obligations that could theoretically be withdrawn at any time. Britain didn't have the reserves to pay. These balances hung over British governments like a sword until the mid-1970s, forcing stop-go economic policies and constraining growth. Every time Britain tried to expand the economy, the threat of sterling balance withdrawals forced the government to slam on the brakes. Britain was trapped in a cycle of weak growth, persistent balance of payments deficits, and recurring currency crises. Between 1946 and the mid-1970s, Britain did manage to reduce the debt ratio through a combination of inflation and modest economic growth. By 1976, debt to GDP had fallen to manageable levels, but the underlying economic weakness remained. Manufacturing as a share of GDP had peaked and was declining. In 1948, manufacturing accounted for 48% of the UK economy. By the 1970s, that figure was falling steadily. Industrial productivity lagged behind competitors. Investment in research and development was insufficient. The pound remained chronically weak and vulnerable to speculation. And then came the Suez Crisis of 1956, the moment when Britain's pretensions to great power status were publicly and humiliatingly destroyed. In July 1956, Egyptian President Nasser nationalized the Suez Canal. Britain and France, in collusion with Israel, launched a military operation to retake the canal. The operation was a military success, but a financial catastrophe. The United States was appalled that military action had begun without American knowledge or approval. President Eisenhower put immediate pressure on Britain by blocking access to the International Monetary Fund and threatening to dump sterling. Sterling came under massive speculative attack. The Bank of England was forced to deplete dollar reserves to defend the fixed exchange rate under the Bretton Woods system. Britain's foreign currency reserves in October 1956 totaled just $2.2 billion. The United States held $3.75 billion in British war debt from the 1946 loan. Britain was grossly overleveraged and completely dependent on international borrowing to maintain its standard of living. Without American financial support, Britain could not continue the Suez operation. The credit blockade effectively bankrupted Britain. Prime Minister Anthony Eden had no choice. Britain withdrew in humiliation. What the Suez crisis proved beyond any doubt was that Britain was no longer a great power. Financial dependency on the United States meant Britain could not pursue independent foreign policy. Sterling's weakness made Britain vulnerable to speculative attacks whenever Britain acted against American interests. The illusion of empire was shattered. Over the following decade, decolonization accelerated rapidly. The financial and administrative costs of maintaining the empire had become unsustainable. Britain lacked the economic strength to project power globally. The retreat from empire was not ideological, it was financial necessity. And here's where the British economic story enters its darkest phase, the 1970s. By 1976, Britain was facing a full-blown sterling crisis. The value of the pound tumbled. The government found it difficult to raise sufficient funds to maintain spending commitments. Inflation was rampant. Industrial relations were catastrophic with frequent strikes. Manufacturing productivity was stagnating. On September 29, 1976, Prime Minister James Callaghan was forced to apply to the International Monetary Fund for a £2.3 billion rescue package, the largest call on IMF resources up to that point in history. Think about what this meant. Britain, which had been the world's dominant financial power a century earlier, which had financed railway construction across continents, which had been the global reserve currency, was now begging the IMF for a bailout. In November 1976, the IMF announced its conditions: deep cuts in public expenditure. In effect, the IMF took control of UK domestic policy. Britain had lost economic sovereignty. The humiliation was total. The trajectory from empire to IMF supplicant had taken just 60 years, and the fundamental cause was not military defeat, not natural resource depletion, not population decline. It was financial mismanagement. Now let's look at what happened to British manufacturing during this period, because the numbers are staggering. Between 1973 and 1992, total manufactured output in Britain increased by only 1.3% over nearly 2 decades. In the same period, manufactured output rose 68.9% in Japan, 55.2% in the United States, 32.1% in West Germany, and 16.5% in France. Britain's manufacturing growth was essentially zero. The share of manufacturing in GDP fell from 32% in 1970 to 21% by 1993. Britain was deindustrializing faster than any other major economy. Manufacturing employment tells an even more dramatic story. Employment in British manufacturing peaked in 1966 at 8.9 million people, accounting for 30% of all employment. By 2010, manufacturing employed just 2.7 million people, or 8.2% of the workforce. Britain shed roughly 6 million manufacturing jobs in 4 decades. Between the cycles of 1964 to 1973 and 1979 to 1989, UK manufacturing employment declined by 1/3, 2.5 million jobs lost, compared with only 10 to 13% losses in France and Germany. The collapse was concentrated in specific regions: the Midlands, the North, Scotland, Wales, the former industrial heartlands. What caused this catastrophic deindustrialization? Multiple factors, but financial mismanagement was central. First, chronic underinvestment. Britain invested less in research and development, less in capital equipment, less in worker training than competitors. Second, an overvalued currency. The periods of steepest manufacturing decline occurred when sterling was strong, particularly the early 1980s and early 2000s. An overvalued pound made British exports uncompetitive and made imports cheaper, destroying domestic manufacturers. Third, high interest rates. Monetarist policies in the early 1980s prioritised fighting inflation over protecting industry. Fourth, and this is critical, government policy consistently favoured the financial sector over manufacturing. The Big Bang of 1986 deregulated financial markets in the City of London, unleashing 3 decades of financial sector growth. But manufacturing received no equivalent support. The interests of manufacturing were sacrificed for financial sector stability. Regional disparities exploded. London and the South East prospered through finance. The industrial Midlands and North collapsed. Between 1979 and 1983 alone, Britain lost over 2 million jobs in industry, 1.7 million in manufacturing in just 4 years during the first Thatcher government. The Thatcher government made an explicit choice: monetarism, high interest rates, an overvalued currency, union breaking, and support for finance over industry. Manufacturing employment fell especially steeply in the early 1980s during a recession triggered by high exchange rates and high interest rates. The recession of the early 1990s added further major job losses. Thereafter, manufacturing output largely stagnated, and manufacturing employment continued to slide even during 15 years of sustained overall economic growth. The economy was fundamentally unbalanced, dependent on consumer spending and rising house prices rather than productive investment and exports. And here's what should terrify you. Britain never fixed the fundamental problem. The current account deficit that emerged in the early 1980s persisted for decades. Even after the pound devalued following the 2008 financial crisis, the trade deficit failed to fall. Britain became a consumption economy, not a production economy. By 2024, manufacturing accounted for only 8% of GDP, down from 30% in 1970. The economy ran persistent trade deficits, financing consumption through borrowing and asset sales. The IMF bailout of 1976 was a warning. Britain didn't heed it. The pattern was ignored. Let's now place this in the broader pattern of imperial economic decline. Spain in the 16th century, Britain in the 20th century. The sequence is remarkably similar. Stage 1, military overextension. Britain fought 2 catastrophically expensive world wars. Stage 2, debt accumulation. War debt reached unsustainable levels, first 135% of GDP, then 270%. Stage 3, currency mismanagement. The return to gold at the wrong rate in 1925, repeated devaluations and eventual loss of reserve currency status. Stage 4, loss of industrial competitiveness. Chronic underinvestment, overvalued currency, and policy neglect destroyed Britain's manufacturing base. Stage 5, financial dependency on a rising power. Britain became dependent on American loans and American approval for economic policy. Stage 6, loss of territorial control. Decolonization was driven primarily by cost, not ideology. Stage 7, domestic political instability. The 1970s saw constant strikes, 3-day work weeks, power cuts, and IMF intervention. The pattern that destroyed the Spanish Empire in the 17th century, the British Empire followed in the 20th century, step by step, decision by decision. Each choice seemed rational at the time: restore the gold standard to reclaim prestige, fight wars to maintain global order, prioritize finance because that's where London excels. But the compound effect was catastrophic. Here's the key insight. Economic decline is not sudden. It's incremental, progressive, and almost invisible until it's irreversible. In 1925, Britain was still a great power. The decision to return to gold at the wrong rate seemed like a minor technical adjustment, but it devastated export industries and began the decline. In 1946, accepting the American loan with convertibility requirements seemed necessary for survival, but it exposed sterling's weakness and triggered the 1947 crisis. In 1956, the Suez humiliation seemed like an isolated foreign policy failure, but it marked the definitive end of British global power. In 1976, the IMF bailout seemed like a temporary liquidity problem, but it marked Britain's transition from creditor to debtor nation, from empire to mendicant. Each decision, each crisis, each policy choice moved Britain further down the path of decline. And at every stage, British policymakers believed they could restore Britain's former greatness through cleverness, through financial engineering, through symbolic gestures like returning to gold at the pre-war parity. They were wrong every time. You cannot restore economic greatness through monetary policy when your industrial base is eroding. You cannot project power globally when you're dependent on a rival for financing. Let's talk about what Britain lost in concrete terms. In 1870, Britain's GDP per capita exceeded every nation except the United States and Australia. Britain was the workshop of the world. By 1950, Britain's GDP per capita had been overtaken by multiple nations. By 2000, Britain was a middling European economy, deindustrialized, services dependent, and running chronic trade deficits. Britain lost the world's reserve currency status. Sterling, which had been the foundation of global trade and finance, became a weak currency subject to repeated crises and interventions. Britain lost industrial leadership. Industries that Britain had pioneered, textiles, steel, shipbuilding, automobiles, were now dominated by competitors. Britain lost the empire, not through military defeat, but because maintaining it was economically unviable. By 1997, when Britain handed Hong Kong back to China, the last significant remnant of empire was gone. Britain lost economic sovereignty. The IMF bailout of 1976 was the clearest symbol. Britain's domestic economic policy was dictated by external creditors. Britain lost regional balance. London and the southeast became a financial centre, but the industrial Midlands and North never recovered from the collapse of manufacturing. The gap between London and former industrial regions remains vast today. Here's what makes the British story so instructive. Every step of the decline was predictable. Keynes predicted the consequences of returning to gold in 1925. He was ignored. Economists predicted the consequences of accepting the 1946 loans convertibility clause. They were overruled. Industrialists warned that high interest rates and overvalued currency were destroying manufacturing in the 1980s. They were dismissed. At every critical juncture, Britain's leaders chose prestige over prosperity, finance over industry, short-term political advantage over long-term economic health. And the result was the complete loss of great power status in less than a century. Now here's the critical question. Was the decline inevitable? Could Britain have made different choices and maintained its position? The answer is yes, absolutely. If Britain had returned to gold in 1925 at the market rate, instead of the pre-war parity, export industries would have remained competitive. If Britain had refused the convertibility requirement in the 1946 loan, or delayed convertibility until stronger, the 1947 crisis could have been avoided. If Britain had maintained industrial policy and investment, instead of favouring finance, manufacturing could have remained globally competitive. If Britain had decolonised earlier and redeployed resources to industrial investment, productivity could have been maintained. Every major economic disaster that Britain experienced between 1925 and 1990 was caused by policy choice, not external inevitability. Churchill chose to return to gold at the wrong rate. Attlee's government accepted disastrous loan conditions. Eden chose to invade Suez without American support. Thatcher chose monetarism and deindustrialization. These were not inevitable, they were choices. Bad choices. Choices prioritizing symbolism over substance, finance over production, political expedience over economic strategy. And each choice compounded the damage, making the next crisis worse, narrowing the range of future options, accelerating the decline. Let's return to the pattern of imperial collapse and what it tells us. The sequence is military overextension, debt accumulation, currency debasement or mismanagement, loss of industrial competitiveness, financial dependency, territorial loss, domestic instability. Spain followed this pattern in the 17th century and collapsed. Britain followed this pattern in the 20th century and collapsed. The Soviet Union followed this pattern in the late 20th century and collapsed. The pattern doesn't care about culture, ideology, or historical exceptionalism. The pattern is mathematical. Once you enter this sequence, once you pass a certain point, reversal becomes almost impossible because each stage creates conditions for the next stage. Debt forces high taxes constrain investment. Low investment reduces competitiveness. Lost competitiveness creates trade deficits. Trade deficits weaken currency. Weak currency increases import costs. Increased costs create inflation. Inflation forces higher interest rates. High interest rates increase debt servicing. Increased debt servicing forces higher taxes. The cycle becomes self-reinforcing. Each attempt to break the cycle through monetary policy or currency manipulation or financial engineering makes the fundamental problem worse. The only way to break the cycle is through productive investment, industrial competitiveness, and export growth. But by the time the cycle is fully established, the financial system is too fragile, the debt too high, the political will too weak. Britain's story demonstrates this perfectly. By 1976, when the IMF imposed austerity, Britain lacked the resources to rebuild industry. The debt burden was too high, the manufacturing base had eroded too far, the skills had been lost, the supply chains had moved to competitors. Recovery would have required decades of sustained industrial investment, protection of infant industries, strategic currency management, and subordination of finance to industrial policy. None of these were politically possible under IMF supervision. The moment for strategic intervention had passed. The decline was locked in. Britain could manage the decline, slow the decline, cushion the social impact, but could not reverse the fundamental trajectory. Here's the final brutal truth about Britain's decline. It was unnecessary. Unlike Spain, which faced resource constraints and military rivals, Britain in 1945 had industrial infrastructure, educated population, global trade networks, and technological leadership. Britain's decline was not inevitable, it was chosen. Chosen through a series of catastrophic policy decisions. Chosen through prioritization of financial sector interests over industrial health. chosen through unwillingness to accept reduced global status and focus on economic rebuilding, chosen through belief that monetary manipulation could substitute for productive investment. Every choice moved Britain down the path of decline. And the terrifying implication is this: if it could happen to Britain, the most powerful empire of the 19th century, the nation that industrialized first, the global financial center, the dominant military power, then it can happen to any nation. The pattern doesn't care about past greatness. The pattern doesn't care about nuclear weapons or technological sophistication. The pattern only cares about the fundamentals: debt sustainability, industrial competitiveness, currency credibility, investment rates, trade balance. Get those wrong, make the same mistakes Britain made, prioritize the wrong things, and the sequence begins. It moves slowly at first, then faster, then catastrophically, then irreversibly. Britain went from global superpower to IMF supplicant in 60 years, from 1914 to 1976. From controlling 23% of the world's population to begging for loans. From the world's reserve currency to repeated devaluation crises. From the workshop of the world to losing 6 million manufacturing jobs. From economic sovereignty to IMF-imposed austerity. The trajectory was clear, the warnings were ignored. The pattern played out as it always does. The empire collapsed not with war, not with revolution, but with a whimper, a balance of payments crisis, and a phone call to the IMF. This is how empires die, not in glory, in debt, dependency, and decline. Remember that.